Distributions. Except as otherwise provided in this subsection, no distribution shall be allowed before the first day of the calendar year in which the account beneficiary attains 18, which, we already talked about as being the inverse of the language before, but they're spelling it out here. Tax treatment of allowable distributions. For purposes of applying Section 72 to any amount, and Section 72 is what creates the 10% penalties on early withdrawals from retirement accounts. To any amount distributed from a Trump account, the investment in the contract shall not include any qualified general contribution. So if you put in qualified money, you can take that money back out without penalty. Any contribution provided under Section 6434, any amount of any contribution which is excluded from gross income under Section 128. So basically, rollovers and the original money you put in, you can take out without hitting a penalty. If you take out other money, like gains from those mutual funds or ETFs that you have, then there are going to be potential penalties if you don't use it for allowed purposes. What is a qualified rollover contributions? There's an able rollover. Paragraph 1 shall not apply to any distribution which is qualified able rollover contribution, and the amount of such distribution shall not be included in the gross income of the beneficiary. And paragraph 1 shall not apply to any qualified rollover contribution. So yeah, those are all fine. Rollovers are clear as far as those additional taxes. And 529AE6, okay, distribution excess contribution. So if you put in too much money, in the case of any contribution which is made before the calendar year in which the account beneficiary attains age 18, and which is in excess of the limitation in effect under Section C2A, which is that 5,000 plus inflation, paragraph 1 shall not apply to the distribution of such excess. The amount of such distribution shall not be included in gross income, and the tax imposed by this chapter on the distributee for the taxable year in which the distribution is made shall be increased by 100% of the amount of the net income attributable to such excess, determined without regard to subparagraph B. So that is an important loophole closer right there. So what this is saying is that if you put in too much money and the trustee, let's say you set it up with Schwab, they send you that money back. If you make any gains on that money while it's in the account, then you're going to lose all the gains. They're going to take that as a tax. This forces all the trustees to not accept excess contributions. So they will automatically send it back to you, which is what they do with IRAs and whatnot. If you over contribute, they'll send you they'll send you a check back. So I've seen this in cases where, when you get closer to retirement, you get an extra booster to your amount to be able to contribute to IRAs. And we had one case this past year where somebody had put in an extra $1,000, which they were allowed to, and the trustees sent them that money back. And they said, this is an excess contribution. And we would say, no, it isn't. We are within the age range that we're allowed to contribute $1,000. And they said, oh, okay. I fixed it. But it's these kind of little niggling details that you got to make sure you have tightened up, both in the legislation and on the actual trustee accounts themselves. So treatment of death of account beneficiary hopefully never has to come up. But in that case, if they die before they attain age 18 over that calendar year in which they would have, any person acquires the account beneficiary's interest in the Trump account, paragraph 1 shall not apply. Such account shall cease to be a Trump account as of the date of death. An amount equal to the fair market value of the assets reduced by the investment in the contract in such account on such date shall, if such person is not the estate of such beneficiary, be included in such person's gross income for the taxable year, which includes such date, or if such person is the estate of such beneficiary, be includable in such beneficiary's gross income for the last taxable year. So beneficiary qualified. Oh yeah. So that covers the treatment of death. So if this gets, voided because the beneficiary, passes away, then it flows through as though it were taxable, which is, not ideal. But all right, qualified rollover contributions for purposes of the section. The term qualified rollover contribution means amount which is paid in a direct trustee to trustee transfer from a Trump account maintained for the benefit of the account beneficiary to a Trump account maintained for such beneficiary only if the amount of such payment is equal to the entire balance of the Trump account for which payment is made. So again, this is reiterating that you can only have one, right? So you can transfer from one to another. Like if you want to change trustees, you want to go from Schwab to E-Trade, let's say, but it's got to be the whole thing. You can't do the partial. Qualified general contribution. Come back to that later. B is made to the Trump account of an account beneficiary in the qualified class of account beneficiary specified in the general funding contribution. And C is in the amount which is equal to the ratio of the amount of such general funding contribution to the number of account beneficiaries in such qualified class. Okay, so not a whole lot actually matters in there, but the general funding contribution means contribution which is made by an entity described in section 170C1, other than in possession of the United States or political subdivision thereof, or an Indian tribal government, or is an organization described in section 501C3, and which specifies a qualified class of account beneficiaries to whom such contribution is to be distributed. So basically what this is doing is this is creating a mechanism by which other entities like, states and charities and things like that can contribute to potential Trump accounts. The qualified class is all account beneficiaries who have not attained age 18 before the close of the calendar year in which the contribution is made, which is the same. All account beneficiaries who have not attained the age of 18 before the close of the calendar year in which the contribution is made, who were born in one or more calendar years specified in the terms of the general funding contribution. Okay, that's fine. Still, if you're in the right place, you have a social security number, you're under 18, you should be fine. Qualified geographic area I thought this was interesting. The term qualified geographic area means any geographic area in which not less than 5,000 account beneficiaries reside and which is designated by the Secretary as qualified geographic area under this subparagraph. If there are any, then you might not be. Trustee selection, customer service, history reliability, regulatory compliance, all that kind of stuff. It's going to be the big brokers. That's just how it is. Other special rules in coordination with individual retirement accounts, which is IRAs. Subparagraph, the rules of subsections K and P of section 408 shall not apply to a Trump account, and the rules of subsection D and I of section 408 shall not apply to a Trump account for any taxable year, beginning before the calendar year in which the account beneficiary attains age 18. So this is just exempting certain sections, right, of the IRA because it's not really an IRA, not yet, right? Because it's a special thing that are being expanded. So they're just carving out penalties and treatments and that kind of, because those are being overridden by this new section. Custodial accounts, so they're adding a section, contributions in the case of any taxable year beginning before the first day of the calendar year in which the account beneficiary ages 18, contribution to a Trump account shall not be taken into account in applying any contribution limit to any individual retirement plan other than Trump account. So basically you can do both is what this is saying, which is great. Let's say you are a 16-year-old and you have a job working at wherever, and you want to put money into the Trump account and you want to put money into the IRA, and you can. So that should be fine. So distribution section 408D2 shall be applied separately with respect to Trump accounts and other individual retirement plans. Again, segregating the two things because, different rules for different things, which is fine. Again, excess contributions. This is on the trustees. So this could be the brokerage houses. They have to do reports and all that kind of stuff. Same kind of thing that we typically see. The trustee shall have to make a report about rollover contributions. The period of reporting, this I thought was interesting. Subsection shall not apply to any period after the calendar year in which the beneficiary attains age 17. Able rollover contributions exempt from able contribution limitation. So you don't have to double count the numbers if you're contributing to an able account, which is fine. And so then we get into other stuff, which I thought was super interesting. They're creating a new section 128 of after 127. So section 127 is what dictates the ability of employers to contribute to educational programs of their employees. That was amended during COVID to include student loan interest. So if you go back, and I've got a blog article about how you can create a tax-free benefit to employees up to $55,250 going towards their student loans, which is great. But they're adding this now.